Today we look into the topic presentation of financial statement for AS compliant companies. Before we dive any further, let's see the components of financial statement, some of the financial statements. Profit and loss statement. What is a profit and loss statement? A profit and loss statement is a statement that shows the company's revenues, profits, losses and expenses during the year. It is also known as income statement and statement of operations. The next one is balance sheet. A balance sheet is known as the financial statement that shows the financial position of a company. It shows the company's assets and liabilities at a specific point of time. The next one is cash flow statement. A cash flow statement is a statement which shows the company's cash inflow and outflows. Also includes cash equivalents. It is divided into mainly three heads: operating, investing, and financing activities. Statement of equity changes in equity is a statement that shows the company's equity during a financial year. It also includes issued capital, reserves, and retained earnings. The final one is notes to financial statement. The notes to financial statement is basically a statement or a footnote that shows the explanatory or additional info of the above details. So now we will be moving into the general instructions for preparation of financial statements as per Schedule 3. Before we go any further, we need to know what Schedule 3 is. So what Schedule 3 basically is? Schedule 3 of Companies Act 2013 basically tells a company that follows AS accounting standards and Indian accounting standards Division 1 and 2 respectively, how to prepare financial statements such as cash flow statement, statement of profit and loss, balance sheet, and as such. Now Schedule 3 will also be applied to non-banking financial companies. Those are companies which are not coming. We will go into the general instruction. The first one. Previously, when there was a clash between the old Schedule 4 and the accounting standard was not given preference, instead the law was given the preference. For an example, previously, AS3, when cash flow was divided into mainly three heads: operations, investing, and financing. But the law was given the preference for companies because the law was mandatory. But now, according to the new revised Schedule 3, the accounting standard is given more preference or takes more precedence compared to the law. The second instruction is that Schedule 3 mandates that if an act or accounting standard requires change in the treatment or disclosure of financial statements, meaning that if an act or the law or accounting standards require some changes in the disclosure, such changes such as addition, amendment, substitution, or deletions, these are one of the changes. These changes need to be done. It could be done notifying the schedules. The next instruction is that to resolve conflict between Schedule 3 and accounting standards. Previously, in the old Schedule 4, there was clash between the schedule and the accounting standards in areas such as cash and cash equivalents. But for now, for improving or reviewing the conflict, it is done that so mainly before understanding that we need to understand what the cash and cash equivalent is. Cash and cash equivalent, according to AS3, defines as a short-term liquid investment with a maturity of less than 3 months. So basically now the Schedule 3 says that cash and cash equivalents can also be known as cash and cash balances and other bank balances to avoid conflict. The fourth general instruction, which is the para 2, talks that disclosure requirements are supplementary to those of accounting standards, meaning that Schedule 3 also has some disclosure requirements, but these are supplementary to the accounting standards disclosure. These meaning that the accounting standard disclosure as well as Schedule 3 disclosures both need to be done. One does not replace the other, both should be done. The fifth one is for disclosures like those of AS24, meaning AS24 talks about discontinuing operations, meaning whenever a company stops business or whenever a company discontinues their business, this AS is followed. So for the fifth instruction, which mandates showing that pre-tax gain and losses on asset disposal and liability settlement should be shown in the statement of profit and loss. This is stated in the AS24, but it is not mentioned in the Schedule 3. But Schedule 3 also says that this should be done, also shown even if it is not shown in the schedule. The sixth one is disclosure required by accounting standards should also be included in the financial statements. Disclosure by the accounting standards should be included in the financial statement, while those disclosures required by the schedule should be like those monetary donations should be shown in the notes to accounts, not in the financial statements unless required. The seventh one shows that disclosure required by other legal obligations like those under clause 42 of listing agreements, such as derivatives, foreign currency exposure, or employee share payments must be included in the financial statements along with Schedule 3 disclosures. This talks that even if Schedule 3 does not mention or even Schedule 3 does not specify these requirements by other legal obligations should also be included in the financial statement, even if not mentioned. Says that Schedule 3 requires consistent unit of measurement for financial statement. Meaning, for the first quarter, if you did it in rupees, the next quarters or the next year's financial statement should also be in rupees. This makes it easier for comparability, transferability, as well as you could compare it with other firms. The next one, the 11th one, talks that Schedule 3 introduces rounding of requirements. It is not necessary, but if you comply with the rounding off, you should comply with the standards necessary. This talks that if the turnover is at least 100 crores, you could make it in crores. Previously, if it was in 500 crore only then you could have rounded off to 500 crores. For those turnover below 100 crore, you could round it up to millions or lakhs. The next one talks that Schedule 3 says that it should align for different ASs have different definitions. So Schedule 3 talks that definitions of accounting standard should be followed. For an example, AS 18 related to related parties and disclosures. In that, the definition for related parties is given. Those definitions should be followed, not the relative or the definition given.
So now we are going to discuss the financial statement of the company, and the first one is profit and loss account statement of the company. So profit and loss account statement of the company includes revenue from operations. The first one is revenue from operations. So revenue from operation is the core revenue that is being generated by the company's main business, especially sale of goods or sale of products, services, etc. And it includes all extra incomes that is being arises. For example, income from investment, etc. And the next, so other income includes all additional income sources that are not being directly connected to the business. For example, it includes income from investment, sale of assets, etc. So the third one is total revenue. Total revenue is a sum of revenue from operations and other income, and it represents the company's total income for the period. So the fourth one is expenses incurred. So this section lists all the expenses incurred by the company during the period. Under expenses incurred, the first one is cost of materials consumed. So the total cost of raw materials that is being used in production activity will come under cost of materials consumed. And second one is purchase of stock in trade. So the cost of purchasing goods that can be resold without further processing will be included in purchase of stock in trade. So the fourth one is employee benefit expense. So all expenses related to employees' benefits such as salaries paid, wages paid, or bonuses given, or other types of compensation that are being given to the employees will come under this employee benefit expense. So it shows the change of value in inventory from the start date to the end date of the period, and if it is a positive change and it shows the inventory usage, and if it is a negative change, then it means it increases the inventory. So the fourth one is employee benefit expense. So all expenses related to employees' benefits such as salaries paid, wages paid, or bonuses given, or other types of compensation that are being given to the employees will come under this employee benefit expense. So the fifth one is finance cost. So finance cost refers to the interest on expenses. So the sixth one that comes under the expenses is depreciation and amortization expenses. So it represents the allocation of cost to tangible and intangible assets over their useful life. And the seventh one is other expenses. So other expenses means all the miscellaneous expenses that doesn't fit under the above category, or that doesn't come under the above category, such as administrative expenses, utility costs.
We already discussed about the profit and loss account. Now we are going to discuss about the balance sheet. Balance sheet is a type of financial statement that describes the financial position of it. Now we are going to discuss about the components of balance sheet, and that is liabilities and the assets. In liability side includes there are 4 items: shareholders fund, share application, maintaining enrollment, and non-current liabilities, and current liabilities. There are 3 items that comes under shareholders fund. First one is share capital. The money invested by shareholders in exchange for share, that is share capital. And the second one is reserve and surplus. Retained earnings and other accumulated provisions. Short-term borrowings means long due tenure, that is short-term borrowings, and the trade payable, amount owed to suppliers, that is trade payable, and the third one is other current liabilities. Short-term obligation not classified elsewhere, that is other current liabilities, and the last one is short-term provisions. Funds set aside for short-term provisions, short-term expenses, that is short-term provision. We have completed the liability side and move on to the asset side. In asset sides, there are two categories, non-current assets and the current assets. Non-current assets are property, plant and equipment and intangible assets. Property, plant and equipment, physical assets like buildings, machinery, etc. So the next one is intangible assets. Non-physical assets such as patent or trademark, that is intangible assets. And the next one is capital work in progress. Assets under construction that are not yet operational, such as capital work in progress. And next one is intangible assets under development. Intangibles that are being created, that is intangible assets. The next one in non-current assets are non-current investment. Investment intended to be held long term, that is non-current investment. And the next one is deferred tax asset. Tax benefit to be used in future period, that is deferred tax asset. And the next one is long-term loans and advances. Loans given out repayable over a long term, that is long-term loan and advances. And the last one is other non-current assets. Additional long-term resources not included elsewhere. The next category in the asset side are current assets. Current asset includes current investment, inventories, trade receivable, cash and cash equivalent, short-term loans and advances, and other current assets. Current investment means short-term investment, typically liquid or readily available, that is current investment. Next one is inventory, goods held for sale or production, that is inventories. And third one is trade receivable, money owned by customers, that is trade receivable. And the fourth one is cash and cash equivalent, cash on hand and bank balance, that is cash and cash equivalent. Next one is short-term loans and advances. Short-term loans made to others, that is short-term loans and advances. And the last one is other current assets. Any other short-term resources, that is other current assets. The both asset and liability side have totals. The total are provided for each section and overall, helping to balance asset with the equity and the liability. This is the format and components that is included in the balance sheet.
In this video, I am discussing about the preparation of financial statement through a problem. The problem is XYZ company provides the following information for the year ended 31st December 2023. The company gives the trial balance the year ended 31st December 2023, and the details are cash is debited as 50,000 and inventory. Opening stock is 20,000 and purchases is 1 lakh and the sales is 1,50,000. Salaries is 30,000, rent 10,000, plant and machinery 80,000 and debtors 40,000 and creditors 20 and capital is 1 lakh. They give us some additional information. They are closing inventory cost 30,000 and depreciation on plant and machinery is 10,000. Their requirements are prepare an income statement for the year ended 31st December 2023 and prepare the balance sheet as on the 31st December 2023 and prepare notes to account to disclose the necessary information. And these are the components of our financial statement. So let's get started. So it's the solution. First one is we need to prepare our income statement in Fiancial. To get gross profit, we want to deduct our expenses from our income. So first step is our sale is 1,50,000. It's our revenue. So we want to deduct our expenses from our revenue. Our expenses are opening stock is rupees 20,000 and purchases is 1 lakh. And cost of goods sold is 1,20,000. After we deducting our expenses through our income, we get the gross profit of rupees 30,000. After our completion of trading account, we next move to the profit and loss account. Here the gross profit less our expenses this income. So our expenses are salaries, rent and depreciation. After deducting our expenses, we get a negative figure. Net profit is 10,000. So after the completion of net profit, we are moving to the next step is preparation of balance sheet. This is the balance sheet of our XYZ company. The year ended 31st December 2023. These are our liabilities. Share capital is rupees 1 lakh, and our current liabilities are only creditors is 20,000. So comes to the asset. They have land and machinery. It costs 80,000. After deducting our depreciation, it's 70,000. Next is our current asset as inventory. It's inventory is known as closing stock. It costs 30,000, and debtors is sundry debtors are it's 40,000. Is our cash in hand. It only 50,000. So after the calculation, we get 1,20,000 as the total of the balance sheet. A point to remember: we didn't add our net profit in this balance sheet because it's a negative figure, so we didn't add to this. It's our end of preparation of balance sheet. Next is our notes to account. It expresses our activity that are we done in our financial statement. That is, we adjusted our plant and machinery depreciation there. So that explains to our notes to account. So plant and machinery opening balance is 80,000. We have depreciation on that year, so that's 10,000. After deducting depreciation from the opening balance, the total is 70,000. So whatever we adjust in our financial statement, that we shows as the notes to account.
Now we can go to the next problem. The following are the ledger balances of SO Limited as on 31/3/2023. Okay. These are the credit and debit balances. Okay, here we can see that this closing stock 80,000, provision for taxation 50,000, then transfer to general reserve 60,000, then reduce recommended dividend of 10%. Okay, the question is prepared for the accounts of the company as per Schedule 3 of Companies Act 2013. Okay, first of all we can prepare the profit and loss account. Okay, for that first you have to give as statement of profit and loss for the year ending 31st March 2023. It should be at the top of the profit and loss account. Then there should be 3 columns. First one is particulars column, then lot number and amount column. Okay. The first particular is revenue from operations, that is sales. That's in the question, that is 4,40,000. Then other income. There is no other income, so it is nil. Then total revenue, that is adding both to here, it is 4,40,000. Then next there is expenses, and the first expense is purchase, and it's given the question that 1,36,000. Okay. The next one is changing inventories. Here we can see there is a lot number. So there is an additional one, that is working note. So we can go through the working note. Okay. Here we can see changing inventories. Then opening stock, that's the question, that is 10,000. Then less closing stock, that is 83,000. Here it's a negative value, 53,000. So you have to give the final value here in brackets, that is 53,000. Then the next particular is employee benefit expense. There is also a lot number we can see here, that is 2. So there is also an additional work. So we can see particulars, that is employee benefit expenses, under which comes wages, that is 10,000 given the question, then salaries 10,000, then you have to add that, which comes 22,000, and you have to give it on the account as 22,000. Then the next particular, that is finance cost. So this is also again a number, so we can go through it. So here, finance cost, and there is debit interest, that is 24,000 on the question. Then interest on loan, that is 10,000, and we have to add both, that is 34,000, and we have to give the profit and loss account, that is 34,000. Then depreciation and amortization expense, that is directly given the question as 30,000. Then other expenses, and there is also a lot number, so there is an additional work, that is office expense given the question 28,000. Then audit fees, that is 13,000, and you have to add both, which gives 41,000. So we can keep other expense as 41,000. Then next step is we are adding all the expenses and we'll get a total expense of 2,10,000. Then profit before tax, that is our third head, that is total revenue minus our fourth head, that is expense. So we have to subtract 4,40,000 and 2,10,000, and which will give 2,30,000 as a result. Then we have to subtract tax expense from it, that is 50,000, and which will give us profit after tax, that is 1,80,000. It will be our net profit for the year 2023. Okay, then we can go on to balance sheet. Okay, it's the balance sheet, and as profit and loss account, at the top of the balance sheet, we have to keep the heading balance sheet as of 31 March 2023. Okay, then here are the three columns as the profit and loss account has, that is particulars, not number, and amount column. And first, the particular column, first we have showing equity and liabilities. Under the head equity and liabilities, there come shareholders fund, and under shareholders fund there comes share capital, and the share capital here is 8 lakhs, which is directly given in the question. Then the second one, reserves and surplus, and having one number 1, so there is an additional work, so we can go through it. Okay. Okay, here reserves and surplus, they are two accounts. First of all, we can look into surplus account, that is surplus account balance at the beginning, that is 1,30,000, which is already given in the question. Then profit for the period, that is the profit we have got from the profit and loss account, that is the profit of the year, which is 1,80,000. First we have to add both. Then we will get 3,02,000 as the result. Then last, transfer to reserve, which in the adjustment is given that 60,000 has to be transferred to general reserve. That is why we are here subtracting 60,000 from this 3,02,000. Then again also there is a proposed dividend, that is which is given the adjustment. So additional information, sorry. So that is 10%. So the 10% of 8 lakh is 8,000. It also should be subtracted from 3,02,000. So while we are subtracting both 60,000 and 80,000 from 3,02,000, we will get 1,70,000. Okay, that's what will be surplus account. Then we can move on to general reserve account. Okay, here we can see 1,80,000 plus 60,000. This 1,80,000 comes from the question, which is directly given in the question, 1,80,000. So it is already there. Then 60,000. We know that we have transferred 60,000 to general reserve. So that adds up with 1,80,000 and gives the result 2,40,000. So then we can add both accounts, that is 2,40,000 plus 1,70,000, and which gives us 4,10,000. So this is how here comes 4,10,000. Then we can move to the next head, that is non-current liabilities. Under non-current current liabilities, there comes long-term borrowings. And there is also additional work. That is long-term borrowings. This is the question of 8% debenture. Is directly from the question, that is 3 lakh. Then 10% loan, which is also directly from the question, that is 1 lakh. When we add both, we get 4 lakh, and which is given here as 4 lakh. Then here comes our next trend, that is current liabilities. Under current liabilities, there comes trade payables, that is 50,000. But we can look how it comes to 50,000. Okay, trade payables. Under the trade payables, there will be a question creditors of 40,000 and bills payable of 10,000. Then we add both, we will get 50,000. Okay. Then we can move on to next one, that is short-term provisions. That is of 1,30,000. Now we can look how it comes as 1,30,000. Okay. Okay. Now number 4, short-term provisions. Okay. Under short-term provisions, there comes provision for tax as 50,000 and proposed dividend as 80,000, which we have already discussed. 80,000. Okay. And 50,000 plus 80,000 gives 1,30,000. And we have divided it as 1,30,000 here. Then we can look for the total of this equity and liability side. Okay, the total of equities and equity and liability is 70,90,000. Okay. Then we can move on to assets. And the first one is non-current asset. Under the non-current asset, there comes fixed asset. And under the fixed asset, there come tangible asset. And when we see note number 5, as we can see, we can go through it. So here we can see there is tangible asset. Under the tangible asset, there comes plant, which is given in the question, that is 6 lakh. Then comes furniture, that is 3 lakh. Then we can earn both 6 plus 3 is 9. So the total is 9 lakh. Then we can see how given it as 9 lakh. Then the next one is non-current instrument, which is 5 lakh, that is given directly in the question. So there is not a number or additional ones. Then the next is current liabilities. And under the current liabilities, as you can see, there comes first one inventories, that is stock. It is of 83,000, which is directly given in the question. Then comes trade receivables. It is of 2,43,000. Now we can look how it comes as 2,43,000. Here is trade receivables, and you can see debtors of 2,40,000 and bill receivable of 3,000. Then we add both, we will get 2,43,000. Okay. And we have given us 2,43,000. Then cash and cash equivalents. It is of 64,000. Okay, then look how it comes as 64,000. Okay, is given as bank balance of 15,000 in the question and cash in hand as 49,000. When we add both, we will get 64,000. Okay. Then we have given cash and cash returns as 64,000. And when we add it, we have got 17,90,000, which is equal to the same equity and liabilities line. So our answer is correct. Total 17,90,000. So please tally it. Okay, and the question, we have solved the question. So thank you for watching our video.